So what are the changes? So instead of looking at your balance sheet and calculating a safe harbor based on average values of assets, the interest deductions are now limited to 30% of tax EBITDA. So EBITDA, as you know, stands for earnings before interest, tax, depreciation, and amortization. And we'll talk about how you perform that calculation. There are two recent changes which are very positive. One is that if you have denied deductions, you can carry forward those denied deductions for 15 years, provided that you meet certain conditions, including a modified court test. But we'll talk about some traps in relation to this shortly. The second positive change is that a lower entity can pass up its excess tax EBITDA to its controlling entity, provided that certain conditions are satisfied. And we'll talk more about this. The worldwide gearing debt test is removed and is replaced with a group ratio test. So broadly, instead of using a 30% fixed ratio, you can calculate a group ratio broadly based on accounting numbers. So obviously you use this if it's more than 30%. You then take that group ratio and apply it to your tax EBITDA. Now, experience overseas suggests that this method is rarely used because of difficulties in getting information at group level. The arm's length debt test is removed and is replaced with an external third-party debt test. Now, the important difference here is that under the arm's length debt test, you could apply it to related party debt. For example, we can see that test being used for loans with parent entities. Under the external third-party debt test, however, unless you satisfy a very limited exception for conduit financing entity, you can only use this test on third-party debts or loans, bank loans. Now, in terms of traps, just be aware that you can switch between methods each year. But if you switch from fixed ratio to group ratio, you could potentially lose all your carried forward denied deductions. So just be aware of that trap. Secondly, the group test and the group ratio test, for example, is an irrevocable test, the same with the external third-party debt test. So what that means is that if you wrongly applied that test or did not meet the condition of that test, you cannot go back and use the fixed ratio test. There is some limited discretions allowed for the commissioner, but I wouldn't rely on that. So potentially, you could be denied part of or all of your interest deductions. So that test is irrevocable. Also, finally, you need to do your transfer pricing first before you do your thin capitalization calculation. So TP before TC.